Everyone thinks OpenAI already won. That's exactly what makes this dangerous. The company that put AI into 400 million hands. The company that turned a research lab into one of the most powerful businesses on Earth. A crash already in motion. Not the kind you see on a chart, the kind buried inside the machine, and almost no one is looking at it. OpenAI started as an ideal, a non-profit, built around one promise: develop AI for humanity, not for shareholders. Then came 2019. Reality arrived in the form of compute bills. Training frontier models was no longer a research problem, it was a capital problem. So OpenAI built a capped profit structure, a compromise that already contained a crack. Mission on the outside, capital on the inside. And for a while, it worked. Then ChatGPT exploded. 100 million users in record time. The fastest consumer adoption curve Silicon Valley had ever seen. And suddenly, the company designed to be cautious had become the center of the biggest infrastructure race in tech history. This is not growth, this is combustion. And combustion always burns something. By October 2025, OpenAI completed its full recapitalization into a public benefit corporation. That sounds technical, it isn't. It may be the moment the original promise began to collide with financial reality. Imagine if Wikipedia suddenly announced unlimited investor returns, welcome, same name, same users, different engine underneath. That's what happened. The original capped profit compromise has now been fundamentally restructured. The nonprofit still controls the board, on paper. But every incentive in the structure now points one direction: growth. And incentives always show up in the product. Leaked Microsoft financial documents, obtained by tech journalist Ed Zitron, show that OpenAI spent over $8.7 billion on inference on Azure alone in the first 3 quarters of 2025. Just to serve the responses, just to answer the questions. That is not a bad quarter. That is a business model under siege. Because unlike software, which has near zero marginal cost, AI gets more expensive the more people use it. Every prompt costs money. Every image costs money. Every reasoning model costs more. Success itself becomes the cost center. The company's own internal projections don't show it turning cash flow positive until 2030. 5 more years of burning, which brings us to Microsoft. Under the current deal, Microsoft receives approximately 20% of OpenAI's revenues, while also being the company's primary compute provider, while also holding a major equity stake. The same partner that charges you to run the machine takes a cut of everything you earn from running it. That is not partnership. That is financial gravity, and it gets worse. Internal projections show OpenAI paying Microsoft over $13 billion in revenue share through 2026 and 2027 alone, while simultaneously buying $250 billion worth of Azure cloud services through 2032. Read that again. That's not a partnership agreement. That's a structural dependency that compounds with every dollar OpenAI earns. The bigger OpenAI gets, the more it owes. The more it grows, the deeper the hole. OpenAI can grow and still bleed harder, so they needed another answer. Axios reported it this week. OpenAI is projecting $2.5 billion in advertising revenue for 2026, scaling toward $100 billion by 2030. Ads. Inside the company that was supposed to be building the future of intelligence. Because the moment advertising becomes a pillar, the user is no longer just the customer. The user becomes the product. And every answer you get starts getting optimized, not just for accuracy, but for yield. That's not speculation. That's how every ad-supported platform in history has worked, every single one. And it's buried in a tax document. In late 2025, OpenAI filed its final Form 990 as a nonprofit. The word safely was gone. The old mission, filed with the IRS every year since the company was founded, develop AI that safely benefits humanity, unconstrained by a need to generate financial return. The new mission, to ensure that artificial general intelligence benefits all of humanity. No, safely. No, unconstrained by financial return. OpenAI's response, the words change to serve the same goal. Words in legal documents don't change by accident, they get removed. Platformer reported the disbanding of OpenAI's mission alignment team. High-level departures followed, tied directly to disputes over defense partnerships and military deployment. These are not isolated events. They are a pattern. When the people responsible for guardrails leave, the risk doesn't shift theoretically. It shifts operationally. Faster releases, looser safeguards, more geopolitical entanglement. This is not corporate drift. This is institutional fracture. A company under financial pressure ships faster. It cuts safety reviews to hit release dates. It says yes to partnerships it would have questioned a year ago. It optimizes the model for the use cases that generate revenue, not the ones that protect the user. You don't see that in the product. You see it in what the product slowly stops doing. Right now, a product manager is asking ChatGPT to summarize a legal contract. A medical resident is checking drug interactions. A lawyer is using it to draft client correspondence. A student is building an entire thesis around it. These people are not just users, they're dependent. And most of them have no idea how fragile that dependency is. And dependency is invisible until the product changes underneath you. Until the answer you trusted starts being shaped by what an advertiser paid to appear next to it. Until the tool you built your workflow around starts optimizing for something other than your outcome. That's not a hypothetical future. That's the direction every incentive in this structure is now pointing. If the flagship AI company, Anawaka, the one with the biggest distribution advantage in the world, is under this kind of structural pressure, what does that say about everyone behind it? The smaller labs with no Microsoft backstop. The startups that raised money on the assumption that API costs would keep falling. The mid-sized businesses that quietly rebuilt their entire operations on top of this infrastructure. None of them priced in what happens when the economics force a change. None of them have a contingency for when the tool they depend on starts optimizing for someone else's outcome. And none of them have a say in what OpenAI decides to do next. Because the real crash isn't coming from failure. It never does. It's not about whether people use AI. They do. It's not about whether the technology works. It does. The crash is that the economics may not yet justify the scale. We've seen this before, and every single time, the people inside it were the last to see it coming. .com companies raised billions on the promise of internet infrastructure before anyone had figured out how to make money from it. The adoption was real, the technology worked, and then the capital ran out before the revenue model did. Streaming, Netflix, Disney, every studio, they spent years buying subscribers at a loss, convinced that scale would eventually fix the margins. It didn't. The margin crisis arrived and the industry restructured overnight. Thousands of jobs, billions in write-downs. Ride-sharing, Uber and Lyft burned billions subsidizing every single ride, betting that dominance would eventually justify the losses. Years later, the structural losses never fully left. Every time, the product worked, the adoption was real, and then the economics caught up. AI is not immune to physics. OpenAI is not failing. That would be simple to understand. You'd see it in the headlines, you'd see it in the layoffs. It would be obvious. What's happening is harder to see and harder to stop. A company succeeding fast enough to outrun what that success actually costs. Publicly, the most powerful AI company in the world. The one everyone is building on. The one no one is questioning. Internally, a machine that may be spending more to answer your questions than it earns from answering them. The gap between those two realities is not closing, it's widening. And the distance between those two realities, that's where the crash lives.